In this lesson, we discuss about capital structure, importance of capital structure, what is the need of capital structure in any institution or any organization, and what is capital structure and its type. If we discuss about the capital structure, and the capital structure is a particular combination of debt and equity used by a company to finance its overall operation and growth. Equity capital arises from ownership shares in a company and claim to its future cash flows and profits, while debt comes in the form of bonds, issues, or loans, where equity may come in the form of common stock, preferred stock, or retained earnings. Short-term debt is also considered to be a part of capital structure. Furthermore, we discuss about capital structure. Like capital structure refers to the combination of mix of debt and equity which a company uses to finance its long-term operations, and capital structure raising of capital from different sources and their use in different assets by a company is made on the basis of certain principles that provide a system of capital so that the minimum rate of return can be earned at a minimum cost. And in capital structure, the sort of system of capital is known as capital structure. And when we discuss about the total required capital for capital structure, there are two main required capital. The first one is from shares and second one is from debentures. And if we discuss about shares, in share we discuss in the form of equity share capital and preference share capitals are used as a shares. And the factors which influencing capital structure is internal factors and external factor. When we discuss about the internal factors are the main capital structures which are the size of business and the nature of business, regulatory and certainty of income, asset structure, age of the firm, desire to retain control, future plans, operating ratios, trading of equity, and the last one, period and purpose of financing is a internal factor used in capital structure. And in external factors which are used in as a capital structure, like in a debt and equity, for the company or an institution in the shape of finance or operations and growth. In external factor, capital market conditions are considered, and the nature of investors, statutory requirements, taxation policies of financial institutions, cost of financing, seasonal variation, economic fluctuations, nature of computations are used as external factors in capital structure. And in optimal capital structure, the optimal or structure or optimal capital structure is the best capital structure implies the most economical and safe ratio between various types of securities, and it is a mix of debt and equity which maximize the value of the company and minimize the cost of capital in optimal capital structure, and which is very important for any institution and any organization. The essentials of a sound or optimal capital structures are: minimum cost of capital is used as a sound optimal capital structure, and minimum risk, minimum return, maximum control, safety, simplicity, flexibility, attractive rules are used as a sound or optimal capital structure in the company or any institution or any business. And the theories of capital structures are net income NI theory, net operating income NOI theory, traditional theory, and Modigliani-Miller theory, which are used in a capital structure. And first we discuss about the net income theory or net income approach. In net income theory or net income approach, it was presented by or propounded by David Durant and also known as fixed KE theory, where the Durant suggests that increasing of value of the firm by decreasing the overall cost of capital, which is measured in terms of weighted average cost of capital. And in weighted average cost of capital, this can be done by having a higher proportion of debt, which is a cheaper source of finance compared to the equity finance in a net income approach or net income theory. And according to this theory, a firm can increase the value of the firm and reduce the overall cost of capital by increasing the proportion of debt and its capital structure to the maximum possible extent. And here it is due to the fact that debt is generally a cheaper source of funds because interest rates are lower than dividend rates due to element of risk. And the second one, source means a cheaper source of fund is the benefit of tax as the interest is deductible expense for income tax expense which are used in net income theory or net income approach. And the computation of the total value of the firm in net income theory or net income approach is the total value of the firm which is equal to V is equal to S plus D, where S is the market value of the shares and market value of the shares S is equal to EBIT minus I divided by KE, which is equal to K divided by E divided by KE, while D is equal to market value of debt, which is equal to face value, and E is equal to earning available for equity shareholder. And KE is the cost of equity capital or equity capitalization rate, which are used in total value of the firm. While computing of the overall cost of capital or capitalization rate here is K naught is equal to EBIT divided by V, where K naught is equal to overall cost of capital or capitalization rate and V is equal to value of the firm which is used in overall cost of capital and capitalization rate. And net operating income theory. What is net operating income theory? When we discuss about the net operating income theory, this theory was propounded by David Durant and is also known as irrelevant theory. It means that according to this theory, the total market value of the firm V is not affected by the change in the capital structure of the overall cost of capital, which is K naught remains fixed irrespective of the debt equity mixed, which are used in net operating income theory. And the assumptions of net operating income theory is the split of total capitalization between debt and equity is not essential or relevant, where the second assumption is the equity shareholder and other investor, that is the market, capitalize the value of the firm as a whole. And the third one, assumption of net operating income theory is equal to the business risk at each level of debt equity mix remains constant. Therefore, overall cost of capital also remains constant, and the corporate income tax does not exist in net operating income theory. And while the computation of total value of the firm in net operating income theory, where V is equal to EBIT divided by K naught, where K naught is the overall cost of the capital which are occurred during the investment in any organization or any institutions, where market value of the equity capital S is equal to V minus D, where S is equal to market value of the equity capital and V is equal to value of the firm and D is equal to market value of the debt, while we compute market value of equity capital. And what is cost of equity capital? When we discuss about the cost of equity capital, where K is equal to EBIT minus I divided by S multiplied by 100, and where K is equal to equity capitalization rate. And also we called it as cost of equity as a KE. And I is interest on debt which are occurred on debt interest. And S is the market value of equity capital. S is used as a market value of equity capital in cost of equity capital. And if we discuss about traditional theory, the traditional theory which was propounded by Isra Solomon, where the traditional theory of capital structure says that a firm value increases to a certain level of debt capital, after which it tends to remain constant and eventually begins to decrease if there is too much borrowing. And a blend of equity and debt financing can lead to a firm optimal capital structure. And according to this theory, the firm can reduce the overall cost of capital or increase the total value of the firm by increasing the debt proportion of the capital structure to the certain limit, because debt is a cheap source of raising funds as compared to the equity capital in traditional theory of capital structure, where effects of changes in capital structure on K naught and V, where as per Ezra Solomon, first stage which are used in effect of changes in capital structure is the use of debt in capital structure, which increase the V and decrease the K naught. How it increase the V and decrease the K naught? Because KE remains constant or rises slightly with debt, but it does not rise fast enough to offset the advantages of low cost of debt, and where KD remains constant or rise very negligibly in the effect of changes of capital structure. And second stage which are occurred in traditional theory of capital structure is during this stage there is a range in which the V will the maximum and the K naught will be minimum in the second stage, because the increase in the KE due to increase in financial risk offset the advantage of using low cost of debt. And in the third stage the V will decrease and the K naught will increase, because further increase of debt in the capital structure beyond the acceptable limit increases the financial risk in the effect of changes in capital structure. While in the computation of market value of shares and value of the firm, where S is equal to EBIT minus 1 divided by KE and V is equal to S plus D, where we discussed in previous slide V is equal to S and D, while K naught is equal to EBIT divided by V. And in Modigliani-Miller theory, which is theory, in this theory, where this theory was propounded by Francisco Modigliani and Merton Miller, which states that the company capital structure is not a factor in its value. Market value is determined by the present value, which is PV, of the future earnings. The theorem states that the theorem has been highly influential since it was introduced in 1950th century, where they have given two approaches. First one is in the absence of corporate taxes, and the second one when corporate taxes exist. And when in the absence of corporate taxes, they use according to the approach of V and its K naught or independent of its capital structure, the debt equity mix of the firm is irrelevant in determining the total value of the firm, because with increased use of debt as a source of finance, KE increases, and the advantage of low cost debt is offset equally by the increase in KE, where the fourth one step is, in the opinion of them, two identical firms in all respect except their capital structure cannot have different market value or cost of capital due to arbitrage process which are in the absence of corporate taxes. And in assumption of approach, which is first one approach, approach assumption is perfect capital market. Second one assumption is no transaction cost. Third one assumption is homogeneous risk class. Expected EBIT of all the firms have identical risk characteristics. And fourth one assumption is risk in terms of expected EBIT should also be identical for determination of market value of the shares. And the fifth one assumption of approach is cent percent distribution of earning to the shareholder. And the last one assumption is no corporate taxes, but later on in 1969 they removed this assumption from the approach. When corporate taxes exist, original arguments that the V and K naught remain constant with the increase of debt in capital structure does not hold good when corporate taxes are assumed to exist, where they recognize that the V will increase, the K naught will decrease with the increase of debt in capital structure. They accepted that the value of levered VL firm will be greater than the value of unlevered firm, which is VU in the corporate taxes exist. And the computation of the corporate taxes which is used in approach, the value of unlevered firm is VU is equal to EBIT into 1 I minus 1 minus T divided by KE, and the value of levered firm is VL is equal to VU plus DT, where VU value of unlevered firm and the second one VL is the value of levered firm, and D is equal to amount of debts, and the last one T is equal to tax rate which are occurred in the corporate tax existing